macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
This week's big question, is the bull market building a top or is it just building a base to go higher? I'll tell you what I think in a few minutes. First of all, let's go to my map from late January. This is my market timer scenarios and probabilities map from January 26th. These are always good for about 3 to 4 weeks. Here were my levels and ranges and probability projections. And this is when we had broken down below 1800 into that 1780 area. I thought we'd definitely have some action back up to 1810 in the 50-day moving average, and I saw good support at 1740 on the S&P. So my base case, you can see, was a 70% chance we stay above 1740. Well, that's exactly what happened, but I didn't play it right. I actually got caught far too long and ended up having to exit some longs down there because I saw an increased probability of going lower. And so if we go back to my map here, you can see that any closes below 1750, I had a 1 in 4 chance that we were going to head to the 200-day moving average and 1700, where there would be a very good cluster of support. What I really wanted to see with the 1740 level was, in my volatile sideways trade, was a flush down there and then a pop back up. So, so when I tried to explain this to my fellow ETF timers, what I was looking for down there was we needed more pain in this trade, and I didn't want to see the market rally right back up to the highs at 1850, because that to me would be sending a message of it's building a top. What we really wanted was, let's get the flush down to 1700, get all the weak hands out, all the easy money over margin traders out, and then the strong hands could slowly lift the market. Instead, Mr. Market played this hand completely different. He took it right back up off of 1740 quickly and gave bulls and bears hardly any time to think. So run the bears back to hibernation, and bulls had to make a big decision about when to jump back in. That's where we are. So let's go to the chart that I was showing last week, where I didn't think this correction was enough. So here's what the 2013 corrections look like in the blue circles. Into March, then into June, and then again into October. These 3 to 6% corrections were nothing, and I thought, well, we can't have a repeat of that. We need something like we had in 2012, the summer of 2012. Something nearing 10%. And so that's why I thought we really needed that flush for this year to be different than last year. Not that the calendar makes a difference, but it is psychology, and it is about we had some new things on the horizon. We've got an emerging markets catalyst, a negative catalyst, earnings season pretty good here, but some doubts about if revenues and margins are topping. And then, the Fed issue. Fed continues to taper. So we had all this stuff piling on. I thought it would give us a bigger correction. It didn't. Where do I stand now? Okay, so let's go to my next chart. This is the Russell 2000. The one thing I knew is that if the Russell got back above 1150, that would turn me bullish again. That's sort of my pivot on the Russell 2000, the 1150 level. We are above there. So, this small cap strength, I don't think you can fade it anymore right now unless it breaks down below 1120 again. So I think you can get long, 1140, risking 1120, and that's small risk for what could be new highs in the Russell. Obviously, the NASDAQ has really led this charge, 7% rally off the bottom. We caught a piece of that, and that is obviously technology and biotech driving this, and biotech has just been a beast. Making new highs. So, all right, so that's the Russell picture. Oh, one more thing here on this chart. Some might be saying, hey, we are going to build a head and shoulders top here in the Russell. Maybe this is a shoulder, the head, and then this is another shoulder. Hey, that's possible. I can show you the S&P chart where this thing might be building a base with an inverse head and shoulders. Here's this congestion in December. Coming up to 1800, we really test the 1780, 1770 level. That's why that level was significant. It had been a top earlier 2 months prior. Then it's 1780, 1770 is support. What do? We go up to 1850. Try and get through, can't. Then we come all the way down to 1740. Now we're back up here. So what would do this market some good health here, building this base to go higher, would be a pullback to 1800, 1790, and then you'd have your right shoulder for an inverse head and shoulders. Now I'm not big on the head and shoulders things, I don't measure them precisely and draw the lines. It's just a general idea of what has happened when you get a peak and two surrounding peaks or troughs. That sort of confirm that price action that, hey, either a top is in or a bottom is in. And then you get a measured move off of that. Well, they work, over 75% of the time, it seems. So looking at this one, yeah, this is why I say a pullback, an S&P to 1800. And because everybody would want to buy that one, it probably won't even get that close. And that's why 1820 is still my pivot there. All right, let's talk about advanced decline. I'm going to show you two different charts. One, the one I've showed you before with the breakout in October, where cumulative net advanced declines, surge to new highs. And then I'm going to show you one from the guys at stockcharts.com, which gets a little more in depth. So this is just the NIAD, the New York Stock Exchange Advanced Decline Issues. So basically, you're looking at net advancers, and this is cumulative. The numbers over here aren't really that important on the scale. The idea here is this green line I've drawn, that we got that breakout in October, and that's when I really ramped up long exposure. We did well in Market Timer, even though we've given some of that back in January. But look at this surge here in February. Now, of course, coming off a low, a correction where everything's rallying, that's when the advanced decline statistics are going to look really strong. Let me give you some more detailed analysis. This is from Art Hill at stockcharts.com. He's using the S&P 1500, and so here's his breakout to new highs. Looks pretty much the same as the NIAD, and so he says the 80%. He looks at the bottom scale here is also advanced decline as measured in on a percentage basis. He says it's not been that strong this month. Look at the previous strength here: 95%, 72%, 76%, 76%, and we're only at 64%. But it's more bullish than bearish. So what does all this speak of? It's breadth, right? It's the NASDAQ, it's the Russell, small stocks, big stocks, various sectors like biotech. Lots of breadth in the market. Not just the Dow stocks. In fact, the Dow has been the worst performing index of the past couple of months here. And so you're seeing broad breadth, growth stocks, NASDAQ, Russell, and this is, money managers heads down picking stocks because they have a positive view of economic growth and earnings, whether it's top down or most likely bottom up if they're stock pickers. All right. On Art's chart here, he highlights this 64% number. I've got another 64% number that I want to show you. This data comes from Bespoke Investment Group, and this is what they're seeing in the trend in revenues. And this is put together by WallStreetDaily.com. This is the percent of companies beating revenue estimates by quarter. So what we're coming into here so far during this earnings season is 64% of companies beating revenue estimates, and this is measured on a quarterly basis. So this is some surprising strength in sales going back. We haven't seen these heights since 2011, and so that's a strong level to look at. Just one data point that I think still speaks well about earnings and the economy and what keeps me bullish. I just wanted a bigger washout. Little tuck down below 1700. I don't think it's going to happen now, and I think we're building a base here around 1800 for new highs this year. So that's my take, and we can play small pullbacks, but I don't think a bigger correction is coming now for a while, and we're seeing institutions voting with their dollars to move stocks higher here. All right, we'll take a look at some similar evidence next week. Thanks for joining me in the kitchen. I'm Kevin Cook.